All right, good morning, everyone. And thank you all so much for being on this webinar today. We really appreciate you being here and leaning into this small but important change as it relates to how we will be delivering our economic and market updates going forward. And the main reason behind this change is that by delivering this information as a live webinar, as well as a recorded version that you can watch at your convenience, we gain back a lot more of our time within our one-on-one review sessions to discuss your portfolio performance, any other financial planning topics that you might want to address, and to just be able to catch up more with you and what's going on in your lives. So we're really excited about this, and of course would appreciate any feedback that you have on these changes. So with that, we're going to jump right in. But before we talk about where we are headed in 2026, it's worth taking just a minute to rewind and recap 2025 because it was anything but boring. We went into 2025 with a new administration, shifting policy priorities, and a very long list of unknowns. Front and center was the conversation around tariffs, which we spent a lot of time describing as sort of adding to this thickening fog and uncertainty that we were experiencing and expecting. Not because tariffs can't serve a purpose, right? Tariffs can be used as a negotiation tactic to help even the playing field as it relates to trade and tariff revenue could help address some of our national debt issues. But we had fog and uncertainty because no one knew how aggressive those tariffs would be, how long they would last, or what the downstream impact would be on things like inflation, corporate earnings, and global trade. That fog really thickened from February through April when we had what is now known as Liberation Day, which was the administration's major tariff announcement across much of the globe. The scope of that was much larger than expected, and markets were left trying to really digest what it all meant and in real time, and it led to a pretty severe correction in the equity market. Layer on top of that geopolitical tensions, ongoing global conflicts, sticky inflation concerns, a Federal Reserve that was stuck in the middle, and it's fair to say that uncertainty was everywhere, even more so than is typical. And yet, despite all of that, 2025 ended up being a very strong year. Corporate earnings held up, consumers stayed resilient for the most part, and we'll talk about that. AI and the productivity boost that comes from AI was once again in the spotlight. And markets once again reminded us that they don't necessarily wait for total clarity. They can move in spite of the uncertainty. So a messy year, lots of fog, but by the end, some of that fog had cleared while other sources of fog have certainly emerged. I think the one thing that we can be certain about going forward is that there will continue to be layers of uncertainty that we'll have to deal with. But that being said, with respect to 2025, again, investors were rewarded for staying the course, and we'll give you the details of your individual portfolio performance when we meet for our one-on-one session. So with that, let's dig into some of the details and how we're thinking about the year ahead. And we're going to start off with a quick summary. From there, as we normally do, we'll talk about and kind of look at our 2026 economic outlook through the lens of those three important pillars that we always talk about of the U.S. economy, which are the Federal Reserve, fiscal policy, and the fundamentals of the economy. We'll take a look at where we are in the economic cycle and describe what economists are calling a K-shaped economy here in the U.S. We'll give a brief review of the markets and some of the key principles of investing that we always want to bring up as a reminder for our clients. We'll take a special look at gold and review some of the merits of gold and why we hold it in the majority of our portfolios. And then we'll wrap up. If you do have questions, please feel free to jot them down, send them over in an email. You can give us a call, or we can discuss any questions when we meet for your individual review meeting. So with that, I am going to introduce Alan Delcourse, our Chief Investment Officer, who's going to start us off with a quick summary of our outlook. Al?
Thank you, Jeff. So I would like to start out by summarizing our thoughts about 2026 and give you the framework of our thoughts and how we developed our outlook. The first point here is the Federal Reserve may just have found a neutral Fed funds rate, neither stimulative nor restrictive. Remember that Fed fund rates are the foundation of short-term interest rates. Typically, when rates are higher, it's restrictive to the economy. When rates are lower, it's more stimulative. But we start to ask the question, has the Federal Reserve found that market neutral rate, or are they just sort of stuck in the middle? And the reason for that is that the Federal Reserve has two mandates, right? It has a mandate of full employment and it has a mandate of stable pricing. So if inflation was starting to kick up, the Federal Reserve would want to raise rates. If unemployment was starting to go up, the Federal Reserve would want to lower rates. So they are in a bit of a conundrum right now, trying to balance the two. Due to stimulative fiscal policy in 2026, and it's primarily from $130 billion of consumer tax cuts that we expect this year, we expect above trendline GDP growth. Current fundamentals of the economy imply a bifurcation of economic activity between the two groups of consumers. Jeff mentioned the K-shaped economy. And basically, we're talking about the upper income people, upper income consumers, which have the benefit of asset values going up, and the lower income consumers, which live paycheck to paycheck and are struggling. So we think there's some social and economic implications from all of that. The US business cycle remains constructive and corporate America is thriving. We think there'll be a continuation of healthy profits and healthy profit margins because of the robust economy, because of the productivity we're seeing, and the resilience of corporations. Um, we believe the markets are due for an increase in volatility in 2026. Got a lot coming up. We have midterm elections. We have the implications of the K-shaped economy. We have a Federal Reserve that's being challenged. And all of those things we believe, including a higher valuation on equities right now, will create that volatility during 2026. But in summary, a neutral Federal Reserve, tailwind from fiscal policy, and a strength of fundamentals worldwide, we believe that there's a good chance for positive returns on a global basis. So we'll take a look at our top-down considerations, which, as Jeff mentioned, considers the Federal Reserve, fiscal policy, and the fundamentals. And the first part we'll take a look at is the Federal Reserve. This next chart is a good way of looking at one of the mandates of the Federal Reserve, which is stable prices. This is the PCE index of inflation, which stands for the personal consumption expenditures, which is the favorite index that the Federal Reserve uses to look at inflation. On the left-hand side, you can see for many years, the PCE was at or below the Federal Reserve's target of 2%. Then came 2020 and came COVID. And then we know all the money that was poured into the system, quantitative easing, fiscal stimulative measures, and inflation significantly rose. Then we know that the Federal Reserve started raising interest rates. We got some balance in the supply chain, and inflation started to come down. And right now, you can see it's kind of sticky, right? As an update, both of these are at 2.8%, but that's certainly above the Federal Reserve's target of 2%. So inflation is a challenge for the Federal Reserve. Now, we take a look at some of the components of inflation or the causes of inflation. Milton Friedman was a professor at the University of Chicago, and in 1976, he won the Nobel Prize for Economics. He's famous for his quote that inflation is always and everywhere a monetary phenomenon. So let's take a look at money supply and the supply of money in the economy. This chart in blue shows M2 money supply. M2 money supply is cash on hand, checking accounts, savings accounts, short-term CDs, short-term money market accounts, money that can easily be put into the system as consumption. But part of the equation is the velocity of money, and all that simply means is the leverage of what money can do. So as a quick example, if you have $100 and you put it in your savings account, the bank has to keep $20 for reserve, but it can lend out the other $80. So that other $80 becomes a multiple of the money and creates more money supply in the velocity or the turnover of money. The point here on this chart, as we look at the far right-hand side, is that we believe that money supply is sufficient right now to support the robust economy that we expect this year. Let's take a look at the Federal Reserve's other mandate, which is unemployment. This is a chart goes back 50 years. We see that the average unemployment rate was 6.1%. We see the spikes that occurred over the years, and typically that was in a recessionary time. Right now, the unemployment rate is 4.4%, but as you can see on the far right-hand side, that's been creeping up. So it's providing concern to the Federal Reserve, and they want to monitor that very closely. Again, that's one of their other mandates to have full employment. Let's take a look at the labor market. Labor market has been slowing down in the last few years, and it really accelerated in 2025. Many reasons for that, right? The uncertainties that we've had in the economy, the immigration issues, etc. But we agree with the Bloomberg consensus of economists that with a robust economy this year, for the reasons that we'll talk about, that we should see labor supply increasing this year. Now, overall, there is a challenge for labor supply because that is part of GDP growth. You have to have labor to grow the economy. Although one of the benefits that we're seeing significantly, Jeff mentioned this, is productivity. So that helps negate some of the issues we have with the source of labor.
So moving on to fiscal policy, the second pillar that we talk about. And just a reminder, fiscal policy is how the government uses things like taxing, spending, borrowing, and other policies to influence the economy. Think of it as Washington's checkbook. So unlike the Federal Reserve, which works through interest rates and monetary tools, fiscal policy can directly flow into and impact households and businesses. And when we look at fiscal policy in 2026, there's really three elephants in the room that we're watching, some bigger than others as it relates to the impact to the economy. The two larger elephants being the One Big Beautiful Bill Act that was passed last year and the federal budget deficit and our nation's debt. And the now smaller elephant, but still an elephant, is the continued issues around tariffs. So let's start with the One Big Beautiful Bill Act. Remember, this is that new tax bill that was passed in July of 2025. Some of the key provisions of this bill, which we went into a lot of detail on during our mid-year commentary in 2025. So we'll shorten it up a little here. But as a reminder, this bill made the tax brackets and estate exclusion amounts from the 2017 Tax Cuts and Jobs Act permanent. Remember, those were set to sunset in 2025. So making them permanent is a pretty big deal because it takes some of the uncertainty around taxation off the table. Of course, an act of Congress could once again change this, but we don't see that happening at least anytime soon. There were also provisions that increased standard deductions, provisions that added bonus deductions for seniors. They increased the state and local tax deductions or SALT deductions from 10,000 to 40,000 and several others. One thing to keep in mind is that some of these additional provisions do have income limits and phase outs. So if your income is above a certain amount, you may not be able to take advantage of some of those more popular provisions that folks are talking about. So it's very important to check in with your CPA or your tax preparer for more clarity on your individual situation. And then for corporations, tremendous amount of tax incentives within the bill, such as immediate expensing of equipment, bonus depreciation, expanded write-offs for research and development, and increased tax credits. So, put simply, this lowers the after-tax cost of investing, hiring, innovating, and expanding, which are exactly the things that tend to drive economic growth. So this tax bill does have the ability to create some significant economic tailwinds over the next few years. And so you put it all together, and this is what we're looking at. According to the Congressional Budget Office, the net fiscal boost to the economy in 2026 is estimated at roughly $277 billion, with that impact continuing, though gradually fading from 2027 through 2029. Now, whether that boost is ultimately inflationary or growth enhancing, or maybe a combination of both, is going to depend on how it interacts with the Federal Reserve's monetary policy and the broader economy. But make no mistake, this will be a major force in the background in 2026. And then you add in the potential for tariff rebate checks, which is there's been a lot of discussion about it. You have to take any discussion seriously with this administration. We're still not sure, really have no idea if it's going to come through. But tariff rebate checks could potentially hit for those making under 100,000. At least that's the initial thought process behind it. You think about strategically and when that might happen, probably implemented more towards the third quarter as the election season heats up. And that could certainly be a boost to consumer spending and economic growth as well, but also could prove to add more fuel to inflation. Going back to what Al was referring to with an increase in the money supply. Remember back in COVID when there were stimulus checks, that was part of what increased inflation during that year. Now, while there were some significant spending cuts to programs like Medicaid and SNAP benefits, this bill did absolutely nothing to reverse the trajectory of our growing national debt. So fiscal stimulus can help the economy grow in the near term, but the longer term trade-offs have not gone away. So if we zoom out from tax stimulus and look at the longer term projections, this chart helps kind of frame the longer term consequences of all that spending. And what you're looking at here is the projected growth of federal debt as a percentage of our GDP. So as a percentage of our economy. And the direction is very clear. It's moving higher and meaningfully so. Now, rising debt doesn't automatically mean crisis, right? The US has carried debt for a very long time, but it does change the environment that we invest in. As the federal government borrows more, it increases competition for capital. So put simply, when the government is issuing more debt to fund our spending, it can crowd out other borrowers, states, cities, corporations, and even consumers. So interest rates could stay higher across the system, regardless of what the Fed does at the short end of rates, which is what they kind of control. And we've seen that in the past couple of scenarios where the Fed reduced rates. It didn't really do anything to longer term rates. And in a lot of cases, those rates even rose. And that's what mortgages are based off of, et cetera. And then another layer here is demand for US debt. Historically, you've got these big buyers like China and Japan that have been large holders of US treasuries. Over time, if those buyers choose to slow or limit their purchases, whether for geopolitical reasons, diversification, or maybe fiscal concerns, you can end up with more supply of our bonds and treasuries and less natural demand to buy those, which again puts upward pressure on long-term rates. So the reason we've brought this up so many times is not to instill fear, but more so just to promote awareness. This growing debt is a long-term backdrop that we have to account for when we're building portfolios. When we shift over now to tariffs, again, a much smaller elephant in the room, but a great real-time example of how policy uncertainty, not just policy itself, can move markets. So think back to March and April of 2025. Again, Liberation Day, which was the rolling out of the highest proposed tariff levels in almost a century across most major US trading partners. Markets reacted quickly and negatively, stocks sold off, volatility spiked, and recession fears increased. What mattered most, though, was what came next. As the weeks and months passed, some tariffs were delayed, others were softened, negotiations began, and investors realized that the initial headlines weren't likely to fully translate into reality. So the rhetoric was aggressive, but the effective US tariff rate ultimately settled closer to about 11%, which was well below worst case fears. And a lot of those costs have been absorbed by corporations, at least for now. As policy uncertainty peaked and then faded, markets recovered almost in lockstep, as you can see by the chart on the right. So the takeaway is simple. Markets react much more to unknown outcomes and uncertainty than just bad news. Once investors could better assess the range of possibilities, even if imperfect ones, confidence improved and inflation and recession fears eased. If we look ahead on tariffs, one additional wild card that's been in the news is the Supreme Court. There was actually a ruling that was expected last Friday on whether certain tariffs were legally implemented. But they once again kicked that can down the road. No ruling just yet. If the court decides to restrict or overturns parts of the existing framework, it could reduce tariff pressure further, or at least limit how aggressively tariffs can be used going forward. And that would mean a much lengthier process to implement any future tariffs under other international trade laws. But for now, the fog around tariffs has thinned considerably. It would likely take a Liberation Day Part 2 if it ends up that that's a legal thing to do, or a sudden escalation for this specific issue to meaningfully disrupt markets again. So we'll move over to the fundamentals now of the economy.
All right. Thanks, Jeff. So this is the third leg of the pillar, or the third pillar, I should say, fundamentals. And we'll take a look at, first of all, GDP growth. Remember that GDP is gross domestic product. It's the total of goods and services produced in the United States in this example. The overall trend line of GDP growth has been 2.1% now since 2001. And we can see on the chart on the left-hand side that we have been exceeding that with extra growth. And we believe that's going to continue this year, 2026. As we look at the components of GDP, we've talked about consumption in the past, right? Because using the elephant, it's the big elephant in the room at 70% of total GDP. But we also, this time, would like to focus on the investment X housing, because there's tremendous capital expenditure going on today by corporations due to the tax cuts and tax incentives, and also due to this tremendous trend that we're seeing in AI build out. So we're going to take a look at that with this next chart.
Yeah, and so it makes sense to talk a little bit about AI here. Again, right now, one of the biggest areas of capital investment is within artificial intelligence. And at its core, AI is this powerful technology that allows computers to analyze data, recognize patterns, and even learn over time. So, in practical terms, it helps process this massive amount of information faster and more consistently. And it's being used across nearly every major industry. But AI requires enormous computing power, requires storage and networking. That's where data centers come in. These are essentially the engine rooms of AI. And as you can see on this chart, the US is the clear global leader here with roughly 2,000 more data centers than the next 10 countries combined. This isn't speculative. It's real infrastructure that's being built in the US. And that kind of investment supports growth, earnings, and productivity within our economy. Another key here, just talking about AI, is that unlike the dot-com era, where anyone with a dot-com in their name had their stock prices going through the roof, Today's AI build out is being led by companies with very strong balance sheets and real cash flow. So companies like Nvidia, Alphabet, Microsoft, and Amazon. These are well established firms investing from a position of strength as opposed to hype. Valuations on stocks are certainly elevated in this space, but we believe we're still closer to the build phase than any breaking point, with earnings increasingly supported by AI itself. And this isn't just about big tech stocks, right? AI investment is spreading across infrastructure, as you see here, power and energy, and companies that are actually using it to lower costs and boost efficiencies. JP Morgan just came out and said that AI has saved them $2 billion. So that's a real tangible example of what this technology can do. Now, of course, there's risks, right? Think about risks to job displacement as a big one. And then the fact that regulation hasn't fully caught up and there's potential for future regulatory surprises down the road. So the takeaway here when we talk about AI is balance. The goal is to understand where this theme fits in the broader economy and in portfolios. And as always, we never want to put all of our eggs in one basket, no matter how well it's performed in the past. But this is key to the fundamentals because it's real money, real capital expenditures being spent in the U.S.
All right, so let's take a look at the consumer. On the left-hand side, we talk about the consumer balance sheet, and this includes high-income earners, low-income earners, millionaires, billionaires, etc. But take a look at this for a second. The total assets right now are $197 trillion minus the liabilities of 21 trillion gives us a consumer net worth that is the highest on record. There's something called the wealth effect, and the wealth effect means that if you feel good about your assets and stock prices are going up, your house price is going up, you have a more of an inclination to spend. So the consumer in total is in very good shape. If we look at the upper right-hand side, we see debt service. And it's debt payments as a percentage of disposable personal income. And we can see that that's at a relatively low level right now of 11.3%. That's good because the less money that households spend on debt is more money that they have for consumption for other goods. Now, the issue really comes in with the lower right-hand side here, and we talk about delinquencies. And we can see a number of items here. Student loans, we know the issues there. Delinquency significantly increasing. Auto loans, credit cards, mortgages, delinquencies are going up. And again, this may be a reflection more of the lower income consumers that have mortgages and are challenged by delinquencies right now. We take a look at the next chart, we want to talk about recession. First of all, we see no imminent chance of recession. And one of the indicators on our dashboard, so to speak, is this chart from ClearBridge, which shows kind of the status of a number of indicators, and it reflects the consumer, business activity, and financial items. So a green arrow means expansion, yellow is caution, X is recession, and the dashes are not available. But we can see that the overall signal is expansion. And we agree with that. And we'll talk about it in a little bit. If we were looking at this dashboard that had 10 out of 12 X's in it, it would be an indication that we're either in a recession or very close to it. So again, we don't think it's imminent. So where are we in the economic cycle? And this dovetails to what we were just talking about because this is the chart that we've used from time to time. It talks about the cycle of the economy. And it always happens, right? You have a recession, you come out of recession, the early stages, you have the mid stages of growth, the later stages and its characteristics, and then you go back into a recession. Now, some of these cycles are longer than others, but historically, over the last 10 or 15 years, these cycles have been longer. This is a chart that we get from Fidelity. And in their assessment, the US is in the early part of the late stage. What's interesting is that about 3 quarters ago, they had us farther towards the end of the late cycle, and they actually moved it back. Now, we would argue that the US is more in the mid cycle because of the characteristics. We've got strong GDP growth, healthy consumers, healthy balance sheets, healthy profits, a neutral Fed funds rate. So we think that we have a longer runway until we have to worry about the recession. Let's take a look at the next chart, which is consumer sentiment. It's a busy chart. For many of you, we've used this in the past, but let me just clear the screen to say that this is a reflection of the survey by the University of Michigan, which has been going on for years. And it's an indication of how consumers feel about their position. And when we say consumers here, we're talking about higher income earners, lower income earners, et cetera. And we know that there's more lower income consumers than there are higher income consumers. The blue dots on top reflect the peaks of consumer sentiment. The blue dots on the bottom reflect the troughs of consumer sentiments. And we can see historically, the gray areas are recessions. We can see historically when there's been a big drop from the peak to the trough, we typically have a recession. Now, as we look on the right-hand side, we see some significant drops in consumer sentiment, but we know we haven't had a recession. If we look at June 2022, that was the lowest recorded consumer sentiment on record. Where we stand right now is lower than 96% of the time with consumer sentiment. But this chart is also good because it shows the contrarian view of consumer sentiment and pessimism. Because if we look at, let's go to November 2008, this chart shows that 12 months after that trough, the S&P 500 was up 22%. If we look at June of 2022 again, 12 months later, the S&P was up 17%. So it's an interesting scenario right now. And again, I think it is a reflection of the K economy. And Jeff is going to spend a little bit more time to explain that.
Yeah, so again, one of the things that we talk about a few times in our monthly emails the last few months is what economists are referring to as this K-shaped economy. And we've received some questions on it, so we thought we'd quickly review what it means and what are the implications of it. So when we talk about the K-shaped economy, think about the two arms of the K. You've got the top arm of the K that slopes up and to the right. And what this really represents is the top 10% of households and consumers. These are the individuals and entities who own most of the financial assets, so stocks, real estate, private businesses, and other investments. And over the last several years, rising asset prices have driven significant wealth gains. So for this group, the economy genuinely feels strong. Markets are up, balance sheets look healthy, and spending power remains intact. Now, if you look at the lower arm of the K sloping downward, that represents the other 90% of households. Wages are technically rising, but only enough to tread water. They're experiencing higher housing costs, student loan payments that kicked back in after a long pause, childcare that goes up, seems like every month in terms of cost, healthcare premiums going up. And so those wage increases get eaten up pretty quickly. So progress exists on paper, but it's barely noticeable in daily life. So from a data perspective, the economy is still growing as measured by GDP, represented by the dark line on this chart. On top of that, we've got, employment holding steady, consumer spending continues to rise on average. But bringing back the information from consumer sentiment, which we just looked at, but it's represented by the light blue line here, this tells that bottom arm of the case story. Again, confidence reflects how most people feel, not how the statistics and averages look. So when gains are concentrated at the top, GDP and the data can look fine while sentiment feels recession like. So when you hear headlines like the economy is growing, and at the same time you hear friends and family members saying, well, it just doesn't feel that way, both things can be true. They're just describing different arms of the letter K. And that can certainly have an impact. It affects how and where money is spent. So if you think about wealthier households, they're continuing to spend on things like travel, luxury goods, and services, while everybody else is focusing on the essentials. So what this means is that continued economic growth with that big, consumer part of GDP, it becomes increasingly dependent on the fortunes of a relatively small group of wealthy households. So if asset prices were to stumble, spending from that group can slow pretty quickly and lead to further volatility. So it's another level of uncertainty and fragility that is on our radar and that we continue to monitor as it relates to the economy. All right, so now moving towards kind of a higher level overview of the markets and investing. And, as we've talked about a lot already, big events and the uncertainty that follows can come out of nowhere and really shake markets up. We had an event happen just a couple weeks ago with the operation in Venezuela, which could prove to create further uncertainty as it relates to geopolitical issues, but for now seems relatively stable. And the markets didn't really flinch when that happened. But from time to time, we do like to show this chart as a reminder that while markets move up and down, the markets have been resilient over the long term. This chart goes back to 1970. It's a view of the U.S. stock market represented by the S&P 500. And you'll see on this chart all the things that you could have been worried about throughout history. Things like, President Reagan getting shot. You've got the Cold War, the Lehman Brothers collapse in 2008. So a lot of really bad and noisy situations. And nevertheless, the markets have come back and continued their rise. So keeping that long-term perspective is so important, especially when those tough times hit. And those tough times are inevitable. They're going to happen again. So let's talk about some of those tough times. And this chart, again, looks at the S&P 500 going back to 1980 this time. The blue dots on this chart represent the largest decline within a calendar year. And the blue bars show how the market actually finished by year end. So for example, in 2020, we all remember what happened, right? The S&P fell 34% during the chaos of COVID. But by the end of the year in 2020, it had fully recovered and actually finished up with a gain of 16% for the full calendar year. Same thing happened in 1987 during Black Monday. Stocks dropped 34%, still managed to end the year up 2%. Just last year, we've talked about it. During Liberation Day, March, April, stocks fell almost 20%. It was almost a bear market, and yet we finished the year up almost 18%. Now, of course, not every year ends with a recovery. In 2008, we saw a 49% drawdown, finished the year down 38%. But again, as history reminds us, and as we've seen, markets have always recovered. In 2008 was an extremely rare occurrence. In fact, it was one of 2 years since 1960 that the S&P 500 was down for the calendar year more than 25%, and only one of 5 years in the last 65 that the S&P was down more than 15%. All came during or around recessions, except for 2022, which certainly had some characteristics of a recession, but was more due to the dramatic increase in interest rates and inflation concerns that we experienced that year. By the way, if you were properly diversified during that year or any of these years where you had major S&P 500 losses, your losses would have been mitigated and hopefully nowhere close to the drawdown of the S&P 500. As we look ahead, in addition to some of the tailwinds that we discussed in our commentary, There's some other investment related things that we want to talk about that could act as a boost to stocks, one of which is the amount of cash that's on the sidelines right now. It's at an enormous level of $7 trillion in cash on the sidelines. Now, if you think about it, as rates continue to come down, if they do, those short term rates on things like CDs and money markets, those are going to have less of an appeal to investors. And some of those funds could make their way into the stock and bond market, creating more demand in those areas and higher prices. Another trend that we're watching closely is overseas stock markets, developed markets like Europe and Japan, and emerging markets like Brazil, China, and other areas of the globe. As you know, diversification in our portfolio extends beyond the US. Last year was one of the first in many where international stocks meaningfully outperformed US stocks. This chart sort of helps explain why and why we think this trend could continue. This goes back to the mid 1970s. The gray shaded periods represent times when the US dollar was declining or weakening relative to other global currencies. The unshaded periods reflect dollar strength or when the dollar is strengthening. You can see these cycles last, in a lot of cases, many, many years. Now, if you take a look at the purple area, when that purple shaded area is above the center line, that is when international stocks are outperforming US stocks. When it's below the line, US stocks are leading. What's striking is how closely those moves line up with the strength or weakness of the dollar. When the dollar is strong, US stocks tend to dominate. When the dollar weakens, international stocks tend to take the lead as foreign earnings become more valuable when converted back into dollars. And what we've seen last year, and that trend might continue, is a weakening of the dollar. And so this trend may continue. On top of that, international stocks still traded at very attractive valuations compared to US stocks, even after the recent gains. And earnings growth overseas is expected to accelerate as well. You add another catalyst. Germany just announced a $500 billion infrastructure stimulus over several years. You've got rising defense and energy spending across NATO. So there's some good reasons for optimism when we look overseas. We did increase international a little bit last year when the tariff issues calmed down a little bit, and we may continue to do so incrementally moving forward. So let's take a look at gold.
All right, we'll take a look at gold, and from a couple different perspectives. We'll take a look at it from risk management, from the demand for gold, and for return opportunities. This first chart talks about how gold has performed in crisis equity markets in the U.S. And that's defined as a drawdown, peak to trough, greater than 15%. So obviously gold is shown here in gold, and the negative numbers, the blue, represent those drawdowns. And to frame this, we use gold as a piece of our alternative investment bucket, and we use it because it has a low to negative correlation to the equity markets, because we want opportunities to have something that zigs when the market zags. If we take a look at the far right, we see recently the Liberation Day. In that time period, the S&P fell 17.3%. Gold was up 6.6%. If we go all the way to the left, we see the 2008. Look at that difference. In the financial crisis, the Great Recession, the S&P 500 peak to trough was down 47%. At that same point in time, gold was up 12%. So we use, again, gold as part of our risk management strategy within the portfolios as a piece of the pie of our alternative investments. Let's take a look at the demand for gold. So when we think about the demand for gold, we have various buyers of gold, right? We have people that buy gold for jewelry. Gold is being used today in technology. And we have investors that want to invest in gold. This chart talks about probably the largest purchasers of gold are central banks. And it's the highest rate of purchases since the 50s and 60s. In the last 3 years, central banks have bought over 1,000 metric tons of gold. And the question is why, right? Part of the reason is worried about inflation, worried about the status of the dollar, worried about geopolitical events. So gold has been described as a universal aspect of value. So let's take a look at how has gold performed over various time periods over the years. And gold has performed very well. As we look here, we have gold, we have cash, bonds, equities, global equities, and commodities over a 10-year period, 20-year period, and a 30-year period. And you can see that the value or the return from gold has held up. So we like the fact that gold has a return opportunity. We like the fact that it is good in terms of crisis markets, like a number of our other holdings. And it makes sense to have it as a piece of our pie. So let's summarize. Um, in our opinion, if you have a neutral Fed, the tailwind from fiscal policy and the strength of fundamentals worldwide, we do expect positive returns in the global markets in 2026. Alternative investments, including gold, should help us to dampen the volatility in our portfolios for our clients. Global growth should provide us with greater opportunities to invest further in developed markets and emerging markets, which we plan to do this year, as Jeff mentioned. Let's take a look at some of the risks, which we always do, right? There's always, it seems these days, geopolitical events, and that seems to happen almost every week. So that's always a concern. But what if there's a significant pickup in inflation due to the robust economy? We don't expect that to happen, but if it does, and the Federal Reserve starts to raise interest rates, that could cause some significant problems for the markets. If there is a decline in the market, and going back to that wealth effect, and the upper income consumers become concerned, they may reduce their consumption level. And remember, we talked about them being the drivers of consumption. Or on the other side, if the lower income consumers, have this fatigue and they might be losing jobs and can't fight inflation, et cetera, and there's more delinquencies and credit issues. So there's always problems that we face. There's always volatility. And remember that a very important investor once said that the flip side of volatility is opportunity. So I want to thank you. Jeff's going to make some comments, but thank you for joining us today. And please feel free to send us any comments that you have regarding this particular presentation. Was it too long? Was it too short? Anything else that you'd like to see included? Please reach out with a text or email. We appreciate it.
Yes, and again, we're just kind of going through some disclosures here, but if you have questions on the material, please let us know. We can discuss by phone or at our upcoming meeting. If you haven't scheduled that meeting, which I think most of you have, but if you haven't, please remember to do so. And if you need the link again for scheduling, let me know and I can send it over to you. So as always, thank you so much for your trust in what we do. As you know, we're always looking out for your best interests, whether that's from an investment management standpoint or other financial planning items. We're here to help you balance your goals and objectives with the strategies that we can help implement to pursue them. If there's anyone else that you think could benefit from our services, we'd love to discuss how we might be able to help them as well. Thank you again, everyone, and have a great day. Thanks.
Thank you.